Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, welcome back to the IceCap Canadian Market Wrap with me, Richard Diaz. In this week's episode, we're going to discuss the ongoing vendetta the federal government has with the oil and gas sector and reality. This is a subject I'm super passionate about. I think it's vital Canadians wrap their heads around some of the key facts regarding Canada's energy sector and its relationship to Canadians. This week's episode will be split into two sections. Number one, killing the golden goose, and two, reality bites. So let's get started. On Monday, Canadians were introduced to the Environment Minister Steven Guilbeault's emissions cap policy. This new policy will require oil and gas producers to cut emissions by a third over the next 8 years. It'll also introduce a cap-and-trade system that sets a legal limit on the sector's emissions and will allow companies to buy and sell emission allowances. The argument that Guilbeault makes is that the oil and gas sector has made huge profits in recent years and should reinvest some of that money into technologies that reduce emissions in the sector. And of course, crucially, he claims that this will have a limited impact on production. We do not believe him. Monday's announcement must be taken into a broader context. Over the past decade, the Canadian federal government has a clear track record and made numerous attempts to neuter Canada's oil and gas industry. They've enacted carbon pricing, stricter methane regulations, a zero-emissions vehicle mandate, although they put 100% tariffs on Chinese EVs. Someone has yet to explain that to me. And then there's Bill C-59, which threatens fines and jail time for firms that say, for example, that natural gas produces half the CO2 emissions of coal. And then there's the Impact Assessment Act, which lengthens the review time for major natural gas projects, especially oil and gas and infrastructure projects like pipelines. It's clear that this is an effort to delay and deny, and to starve the industry of capital and clarity that the projects need. There's also attempts to punish banks for lending to energy companies. Parliament just conducted a study a month ago, and the motivation there was quite clear. The result is that mineral exploration capex, which is mostly oil and gas capex, is at a 30-year low when adjusted for inflation, and output is stalling. The aim of the federal government is very obviously to kill output. Any suggestion otherwise is, in my view, quite naive. And so Alberta's PM, Daniel Smith, is justifiably pissed off. The idea that emissions caps will not affect production is baloney. After years of various attacks on the industry, it's impossible to believe the minister when he says the goal is not to cut production. Furthermore, the emissions cap comes at a time when Canadians' economy is on its knees. We've talked about the fact that it's already in a recession and what the motivation was for the BOC's jumbo rate cut. What Canadians need to realize is just how much money the oil sands pumps into government coffers. In 2022, the latest data we have, a record high $34 billion in royalties were collected by the oil and gas producing provinces in Canada, and the oil and gas industry paid the federal and provincial governments nearly $12 billion in income tax. $46 billion a year is a lot of money. To put that into perspective, the estimated cost of the high-speed rail project from Quebec City to Toronto is about $80 billion, and to put an even finer point on it, Halifax's new hospital will cost about $3 billion. Guilbeault said in an interview that everyone should be doing their fair share. He was, of course, referring to cutting emissions. But I'm here to tell you that between the huge royalties, the corporate tax take, and the massive transfer payments, Alberta is doing their fair share. Alberta's oil exports is Canada's golden goose, and the blatant and persistent attempt to suffocate it with ever more regulation will eventually kill it. And that's really important for Canadians. It's not just Alberta, and I'll explain why. This is the most important chart of this week. It's the current account balance. In simple terms, it's money flowing in versus money flowing out. It includes trades in goods, services, and financial flows like dividend payments from overseas investments. The importance of a current account balance also lies in its role as an indicator of economic structure, competitiveness, and the potential vulnerabilities. A massive negative deficit must be financed by foreign monies, and if it's too large or unsustainable, it will get corrected, sometimes painfully so. This happens through an internal adjustment, less consumption, or through an external one, a lower exchange rate, higher inflation, and eventually less consumption. As you can see, for Canada, thankfully, it's roughly in balance. This is because of oil. Canada sells oil to pay for imported goods. Canada is the fourth largest producer of oil in the world, behind the US, Russia, and Saudi Arabia, and the fifth natural gas. It is our largest export, and that 4.6% of GDP is a net trade contribution that cannot be overlooked. Without this massive, sustained, positive contribution from energy products, Canada and Canadians would face a painful internal or external readjustment, resulting in less consumption and less government spending, a fate that is always felt disproportionately by the poorest in our society. So who do we sell this oil to, and what do we get in return? The answer is the US and US dollars. And this is doubly useful. Our largest trading partner, and this currency pairing allows us to mitigate the relative weakness in our economy. We've talked about our productivity woes, household debt burdens, and lack of business investment. Well, all things being equal, this would lead to a much weaker currency. Crude oil props it up. This chart further fleshes out our trade data. As you can see, it's not just oil. Canada has a trade surplus in natural resources. And to be clear, we do export billions of dollars worth of consumer goods and chemicals and services, etc. But what matters for our current account balance, our currency, inflation, is the net export number over time. And the continued attacks on our biggest export, should they succeed, will have real consequences. Ongoing attempts to neuter the Canadian energy sector and the dogmatic commitment to arbitrary emissions goals, a rounding error in global terms, is an act of economic self-harm, the consequences of which are never felt by rich people. They have assets. They can float over inflation. Government officials have ring-fenced pension pots and expense accounts. The painful readjustment, like much higher inflation or lower currency, is always felt by the poorest in our society and those with the narrowest shoulders. That's a wrap on this week's episode. Thank you so much for listening. Please like, subscribe, and follow for more. And please share this with a Canadian that you know and love. Always feel free to get in touch with me, and thanks again.